Traderfirstyear with a new trade, and this is going to be going against the grain. So this is a Tesla short trade. I think the market's reached a point of irrational exuberance, and it's completely unsustainable given the global economic outlook for 2020 into 2021. There's a lot of catalysts, but the following catalysts can be summed up into one formula based on the slowing growth in the U.S. economy, and that's just the current account, which equals the U.S. national savings minus investment. And we've noticed a lot of weakness in investment in business investment over the course of the last 3 quarters. We've seen a continued slowdown, in fact, a substantial deceleration in consumption. Net exports, which haven't actually dragged over the last couple of quarters, but you've seen extreme slowing growth in exports and also slowing in imports, which is the import growth slowdown is probably a sign that U.S. consumers are slowing down in terms of demand. And there's also going to be or has been a substantial slowdown in government spending and investment over the course of the last couple of quarters. So given that outlook and just given that formula, this is part of the rationale for the trade. I think there's been a substantial and excessive run-up in algo-driven Federal Reserve QE light, excessive multiple expansion, and a run-up in the first half of the year that is likely to end very messy in terms of a meltdown later in the year. You can feel free to respond if you disagree, but this is presenting a great opportunity for traders who see the most recent upside push as completely unsustainable. Like I said, there's a substantial amount of irrational exuberance taking place. If you'd like to disagree, feel free, but please limit the name calling and state your differences in opinion. But for now, any traders looking to take on are taking the risk of calling a top can do so via this trade on Tesla. And I'm suggesting both writing against Tesla that you may hold, or taking a step further out along the risk curve and writing a naked call against Tesla stock that you do not hold. The latter of the two trade ideas is extremely risky, but given the idiosyncratic ups and downs in price of this stock, which everyone knows its implied volatility is relatively high and it can move 150 points up just as quickly as it can move 150 points down. But any erratic moves or idiosyncratic moves in Tesla are likely going to be extremely profitable over the course of the next 180 days, assuming again that this is a short, effectively a short position on the long stock. So the buy right would be you hold the stock and you want to write a call against it, deep in the money call against it. The further along the risk curve is going to be the naked right, where you're writing a 20 contract call deep in the money against the stock that you do not hold. And it's going to be I think the meltdown is probably going to come within at least 180 days of this trade date. The trade's good until September 2020. Why? I think I listed a number of catalysts that are causing the upside, which are probably not likely sustainable over the course of the next 6 to 12 months. So you're basically selling a Tesla deep in the money call with a strike price of $600 with a contract expiration date of 1/15/2021. The theme again is you're a hedge fund or a trader that bought the stock 6 months ago and you have a healthy profit. You're willing to part with the shares at $600 in the worst case scenario, meaning that if the stock were to fall all the way down and you had call away risk. You don't place any ex-dividend call away risk with Tesla since they don't pay a dividend, but you do have call away risk once it's $600, assuming that someone wanted to call the shares back. However, you want to fund the reason that you're bringing in premium income here is that you want to fund a larger leveraged short position by actually going out paying premium for maybe puts on the equity indices. So you're going to collect, in terms of premium income, about $739,000 on the 20 contracts that you're going to write, which is a fraction of your notional risk, which is about $1.8 million. Based on today's price, you have, again, like I said, no problem locking in a 100% profit on Tesla, assuming that you actually did hold the shares long and you're up, and so you're not really that worried about selling, having the calls, the contracts called away from you at $600. So your break even on this trade would be about $969.70. So anything below this price on your short right is profitable. So again, you're going to collect the premium today. That's going to hit your account immediately when you sell those 20 contracts. And the biggest risk here is that you can either leave that cash sitting in your account, or you could actually go out and leverage it and invest it in higher yielding assets. I tend to go out and invest in higher yielding assets. So given my outlook on the overall economy and actually the equity market, I would be more likely to go out and buy longer duration puts on each of the indices, like the SPY, the Dow Jones, and the NASDAQ, the QQQs, DIA. So the risk you face with this Tesla position is ultimately Tesla does one of two things, given the high implied volatility. It either rockets up and melts your face going up. So let's look at that as an example or a hypothetical here. So today's price was about $911. Let's say it ran all the way up to $1,400. The call that you sold was $669.74. The price, if the stock ran all the way up to $1,400, the call would go all the way up to $822.88. You would effectively lose about 122% of your investment, and you'd be on the line to cover. So if you held the stock long, your long stock value would move up in anticipation with the stock price. However, your call would also move up in price, which means you would have to cover that, and you'd have to use your long stock to cover that. So you'd end up having to cover about 1.6 million on that, which would leave you about 1.1 million after you covered, assuming that worst case scenario the stock ran all the way up to $1,400. Now, what we're looking to have happen here is the price actually goes down, and instead of seeing an effective move of $200 or $300 upside, you see an effective downward move of nothing more than 150 points. And if you saw 150 points, let's say it goes all the way down to $825 from today, like a 100-point move down, the calls that you sold would be worth about $298.21, which means you would effectively have maybe a 20% to 25% gain. So the market value of those calls would now be that you sold would be $596,000. Remember, you took in premium of $739,000, so you got to cover that, and you'll be left with about $150,000, give or take, or maybe $183,000, give or take. And that's an extraordinarily high return in a relatively short period of time if the stock were to decline. So if you annualize that return and you got this return within the next 30 or 90 days, you'd cover that position, you'd be out of the stock. So your expiration date, you're not looking necessarily to hold the stock all the way to the expiration date, nor are you looking for the stock to go all the way down to $600. You're just kind of really looking for it to go below 900 and maybe $150 below the 900 price that it's currently at right now. And then you cover, you walk away, you have a very nice profit. If you sold it naked, you have an extraordinarily nice profit. If you held the security long, you still have a very nice profit, and it's a really good yield. So if you take on the trade, good luck. Thanks for listening, and I appreciate you following.